some things that I didn't include in here. So I hope that if you have questions, please feel free, or even scenarios, as a matter of fact, definitely shout them out, ask questions, throw them in the chat box. But I hope this evening that we can all kind of re-enlighten ourselves on just the benefits of introducing to our VA veteran or our VA buyer about VA home loans as an option to purchase their home. Again, my name is Treissa. I'm with Independent Bank Mortgage. I'll have my contact information at both the beginning and the end of this presentation. And if you have any additional questions, just reach back out to me. So let's jump into it here. So first of all, it's always good to know who is eligible for a VA loan. In most cases, of course, it's going to be an eligible veteran, one that has met their length of service, and through their entitlement, they have determined that they can be guaranteed a loan. And so when I am having a consultation with a veteran, one of the things that I always make sure the veteran can provide to me is a certificate of eligibility. Has anyone not heard of the certificate of eligibility? And I thought I put a screenshot here, but this is actually a document that either the veteran can obtain or even the lender can obtain, but it allows us to determine what type of funding the veteran is eligible for, if they've had previous VA loans, if they are required to pay a funding fee, and we'll talk about that in a minute. So again, during the consultation, we first determine that the veteran is eligible for this type of loan, but not only is the veteran eligible to apply for a loan, many times the eligibility of the spouse of a veteran may be eligible to apply. And that can be someone who's an unmarried surviving spouse of a veteran. So if a veteran has passed away and they were married and that individual has not gotten remarried, they may be eligible for a veteran's loan. It may also be the spouse of an active duty member. It could be a surviving spouse of a veteran who's died from non-service connected causes. So as you can see, there's quite a few options that not only may the veteran be eligible to apply, but also their spouse as well. Now, when we talk about the veteran's loan, even though we all know that the VA loan is 100% back loan, which means the buyer does not have a down payment, there is what we call a funding fee. And that's a one-time payment that the veteran pays in order to secure this type of loan. Now, this fee helps to lower the cost of the loan for the U.S. taxpayer. So in most cases, it is a required fee in the exception that your buyer or your veteran is exempt. And again, on that certificate of eligibility, we also we can acknowledge if that veteran is exempt from that funding fee. That funding fee, depending on if the veteran has used their VA loan before, is typically going to be a percentage of their purchase price. Now, that funding fee is financed into their loan amount. So they don't have to bring those funds to closing, but it does become part of the amount that's financed. Any questions about the funding fee? All righty.
Oh, they'll automatically get the funding fee just because they're a veteran, because of their the approval right. There's no stipulations. Everybody can get the funding fee. Is that correct?
Well, the funding fee is a charge to the veteran. Mm-hmm. So I think right now it's 3% of the purchase price. So every veteran, if they're applying for a VA loan, they are required unless they are exempt. And typically those that are exempt, let me go back.
It has to do with like their length of service. And
that is correct. That's correct. And so on this presentation, it says if your VA compensation is service connect, if you like disability, those are typically veterans that are not required to pay for that VA funding fee.
Right. I was looking for the exemptions. Mm-hmm. Yeah. Okay.
Yep. So that means that they are exempt. Thank you. And so when it comes to VA loans, just like any other type of loan, we do have to analyze the veteran as far as their credit. We analyze their employment, we analyze their income. So there are no differences in what we do when it comes to a VA loan. However, there are slight differences in the guidelines on how we analyze, for example, the veteran's credit. So I've just put a few examples here, and you may find that they're a little bit similar or maybe just a little bit different from other government loans, such as an FHA loan. Now, with the veterans loan, we are going to look at their past repayment practices just to understand how they've handled those obligations to get an indicator of their willingness to pay for the mortgage loan that they're applying for. So we're also going to determine if they have unsatisfactory credit or if their credit is determined to be satisfactory. Now, VA does not actually have a minimum credit score, but you'll find that many of the investors that your lender corresponds with, they will have a minimum credit score. So Independent Bank, for example, corresponds with a variety of lenders and investors, THDA and other mortgage companies, and they each have set their own minimum for that VA credit score. So that is going to vary based on the lender and who they correspond with. Now, when it comes to credit analysis, we're going to look at what we consider adverse credit, and that can be anything from bankruptcy, foreclosure, derogatory credit such as collections, late payments. But one thing about VA, if that veteran has reestablished their credit over at least a 12-month period, credit is considered to be reestablished. That's somewhat a little bit different, even for an FHA loan. FHA loan, typically if you've had multiple late payments in the past 24 months, your credit may not be considered to be satisfactory. So that is a little bit less strict as what an FHA loan would be. And so when we speak specifically about types of adverse credit history, of course, we may identify things such as medical collections and charge-off medical collections. Those type of adverse reportings, they typically do not affect the veteran. So normally when we do see medical collections, the veteran may not be required to pay those off unless it has been subject or reduced to a judgment or a lien. So typically when it goes to that type of reporting, then we do have to address those. Now, when it comes to non-medical collections, and that can be anything from a credit card collection, it could be repossessions, anything in an actual collection status, we do have to analyze that, especially if it's reported on the credit report. It's likely going to affect the borrower's overall credit history. Typically with collections, we do have to add that in the debt to income. So if the borrower does not have a payment, we're normally going to count 5% of that collection towards their obligations, which means that they may not necessarily have to pay that debt off, but it will affect their buying power if we're counting 5% of that balance as part of their debt to income. So that's always something that we're going to analyze to see, even with open non-medical collections, while they may not be required to pay it off, we need to know how it affects their debt to income. Any questions so far? Anything interesting or something you didn't know? If not, just wait. You'll probably hear something very soon. In addition to non-medical collections, we also have to analyze their charge-off accounts. Again, charge-off account, because typically the creditor is no longer pursuing the collection of the account. It may not be something that we have to automatically require the buyer to pay off, but we do have to make sure that we identify it as part of their overall credit history. So again, if it's something that's recently happened and it has multiple late payments, remember that if that borrower doesn't have a 12-month satisfactory pay history, then this could be something that affects the borrower. And this could be with any range of credit score. So it's not just the credit score that we focus on here, because remember, VA doesn't have a minimum credit score. We're actually analyzing the credit itself. So outside of your basic collections and charge-offs, let's talk about judgments for a minute. Of course, account balances that have been reduced to a judgment, that means that that buyer had to go to court and they were required to pay either a repayment plan or set up to pay the balance in full. So we have to have a history of how that veteran has made those payments. Now, there are some circumstances where, let's say, a veteran just recently had a judgment put on them in the past few months, and they don't necessarily have a pay history on that. We do analyze these things case by case, so it's not something that's absolutely set in stone, but it is through the underwriter's discretion to determine how that veteran handled it. For example, if they immediately addressed the judgment as soon as it filed and they began payment, then that may be considered as satisfactory for the underwriter. But again, it all boils down to how they've reestablished their credit in the past 12 months. In addition to judgments, we also may have a veteran that has gone through some type of bankruptcy. Now, keep in mind, bankruptcy does not automatically disqualify a veteran from a loan, but we do have to analyze their complete information and understand the facts and the circumstances that surrounded that bankruptcy and even the type of bankruptcy that was filed. So if you have a veteran that filed a Chapter 7, if that Chapter 7 was discharged more than 2 years ago, it may be disregarded. So we're not going to question any additional information from that time. Now, if that bankruptcy was discharged within the last 1 to 2 years, we possibly may have to determine the satisfactory or the credit risk factors unless certain requirements are met. So let's say during that discharge within the last 1 to 2 years, the veteran has obtained additional credit subsequent to the bankruptcy, and they've made those payments on time. We also have to analyze and understand the circumstances that may have been beyond the veteran's control. So let's say the veteran became unemployed, the veteran may have had an excess of medical bills. And so those circumstances, even a divorce, we have to analyze the circumstances of what happened during that time. So again, that's why it's just so important, in my opinion, that any consumer, and even particularly a veteran, they sit down and speak with the loan consultant, because in just a general conversation, you may not get all of this information. So it's very important to understand not just the veteran circumstance, but any buyer's circumstance. Any questions?
Yes, Madam Treasurer. I have a question. Can the veteran, if they are in a position where they had to file bankruptcy or whatever, and they got through the bankruptcy, let's just say it was discharged and not dismissed, would they be able to use trade lines as a way of reestablishing credit if they have limited income?
So could they use non-traditional credit?
Yes, non-traditional things I don't know, their cell phone bill,
internet bill. So typically that could be used in most circumstances, but on the Chapter 7, that's going to be an automatic discharge. Now, the Chapter 13 may be one that was dismissed, which means that they did not complete the payment plan that was required of them. And so that could be a little bit different, because it still boils down to what have they done in the last 12 months, Governor Thompson. So, if we can't see the established credit over the past 12 months, that's going to be the key to that buyer and any veteran buyer. So if they filed Chapter 13 and that Chapter 13 was dismissed, then we do have to analyze what credit has been established during that time. And non-traditional credit, I would need to double check that, but VA guidelines does not provide, or I did not see any particular guidance when I was gathering this information in regards to non-traditional credit.
Okay, that's
But
all I wanted to be sure of, because I have somebody that was asking me, but they don't have, you know, they are not at the point yet. They've been out of their bankruptcy for like over the 2-year period, but they was kind of afraid to, you know, go out and get like traditional, like a credit card to restart. You know what I'm saying? So that's
gotcha.
why I was asked.
Well, and I'm glad you brought that circumstance up, because if they have been 2 years or more out of that Chapter 7, then they probably are still eligible to apply if their credit score meets the minimum credit score for whatever investor is being used to analyze their loan with.
Oh, okay.
Mm-hmm.
Okay, I'll let them know that. Thank you.
Absolutely. And so for Chapter 13, again, because this is a filing where there has been a payment plan scheduled for the buyer, we're typically going to look at that the borrower has made payments at least satisfactory over the past 12 months. Now, as you know, just similar to an FHA loan, they also have to get that approved through the bankruptcy court as well to ensure that they can apply for a home loan. But again, we definitely want to analyze every buyer and veteran buyer that has experienced a Chapter 7 or a Chapter 13. So definitely, Kate, make sure you're referring them to myself or your lender to understand what their options are when it comes to financing after that type of event has happened. Any other questions?
You got it. Thanks, madam.
Say that again.
I was just saying thank you. That helps me a lot.
I'm glad that you asked. And so the next credit event that may happen, because life happens, right, is a foreclosure. And so if a foreclosure similar to Chapter 7, if it's been more than 2 years from the date of closing, then it's probably not going to adversely affect your buyer. But we do have to make sure that we can determine the transfer date of when that foreclosure occurred. And then also, once again, we're going to look at the circumstances if they were beyond the buyer's control. Did it have anything to do with unemployment, medical expenses, and so on and so forth? And there just may be circumstances that may not be listed here, but everybody goes through some things. It could have been a death of a spouse. So it's important that I believe as a realtor that you make sure to have your buyer be comfortable with speaking with their lender so that we may understand those circumstances to ensure that we can meet those credit conditions when the credit is being analyzed. And so outside of credit, as I mentioned, we do have to analyze other things as far as their debts and obligations. And so one of the things that we're going to look at when it comes to the obligations that are reported on the credit report, we're going to count any debts and obligations with the remaining term of 10 months or more. So if they have, let's say, an auto loan that's going to be paid off in 8 months, and that auto loan payment is not a significant payment, we can likely exclude that when we're calculating their debt to income ratio. Now, in some cases, when there may be accounts with terms less than 10 months and the payment is so large that it could severely impact the resources for even just a short period of time, we do have to factor that into their debt to income. One of the loans that I've just recently closed, I had a buyer, I believe he had an installment loan, probably with a balance of about $3,000, but the payment was about $700 a month. And even though it was going to be paid off within 10 months, I still had to count that obligation as a monthly payment in his debt to income. So if that $700 affected how much he could qualify for, it may have been a scenario where it may be something that we could pay off at closing. And that would help to relieve that buyer of having to count that obligation in. So again, we're not only looking at, what that obligation is, but what amount of time is remaining for that obligation, and if that payment is considered to be significant or not. One thing that I noticed that's a little bit different is how we count student loan payments. Most of you are probably familiar with us counting 0.5% or 1%. VA is actually a little bit different. Now, if a buyer has a student loan and that student loan is going to be deferred for at least 12 months beyond the date of closing, then we don't have to count a payment. Unlike, let's say, an FHA loan, even if that loan is deferred, we have to count 0.5% against that debt. If a student loan is going to be in repayment or within the next 12 months after that VA loan closing, we do have to calculate a payment. Now, the threshold that we use is we take the balance, we multiply it times 5%, and we divide that by 12. So instead of just using a 0.5% threshold, I have found that dividing that by 12 makes that monthly obligation much less than comparing it to other loan programs. So I thought that was a little bit different for student loan obligations. Did anyone else know that?
I did not. That's good information.
That is good information, especially if a loan is deferred, because most of the time the credit report will let us know when that deferment period ends. So that automatically lets us know how we're going to analyze that debt when it comes to their obligations. Now, one thing that we do, and I'm not sure if anyone has ever had this experience, but when it comes to a government loan, there is an additional validation that we run, and it's called a CAVRS report. And that's a credit analysis, identification, verification, response system. I could be wrong on that, don't get me wrong, but who's heard of CAVRS before? CAVRS can sometimes come and sneak and bite us in the behind now, can't it?
Absolutely. I've had that happen.
Yes. And especially depending on when that CAVRS report is retrieved, which we typically like to retrieve it in my world as soon as possible, because sometimes a veteran doesn't know, or even just the buyer, they don't realize that some federal debt or loan that they've obtained that's gone into default is actually being reported. And so what CAVRS is, it's a system that enables lenders, participating lenders, to learn when a borrower has previously defaulted on a federally assisted loan. So there's a declaration in the application where the buyer actually answers if they have a loan default. Most of them say no. But what a federal loan default could be is a student loan. I have seen small business administration loans before, and that's typically a newer one that's come up post-COVID time. So if a buyer is found to have a delinquent federal debt through CAVRS, then they are absolutely going to, first of all, halt the loan process. You know, when it comes to a government type loan, if there is a validity or delinquency reported on that, we can't proceed. And so we do provide the buyer with a contact number to the credit agency that's reporting that default. Typically, each credit agency will have a certain timeline and a certain matter of steps that the buyer can take in order to get that default release. So that is definitely something for both a VA loan and FHA loan. And some of our in-house loans also use that CAVRS report. So it can, like I said, come back and bite you in the behind, because all of the previous information that I've discussed when it comes to analyzing credit, analyzing debt, they could be clean as a whistle. But then this CAVRS report can come up. So it is certainly an important factor to keep in mind.
So what about Department of Justice liens? Like, what about if something happened with one of those or UCC filings? Would those be like if the SBA did a UCC filing against
I have seen those SBA. I actually have a client right now, Kay, who had one of those SBA filings reported as a default.
Okay, yes, that helps. Okay, thanks.
Yeah, so it's something that you know, even though they could easily say, no, I don't have a federal default, again, through just the consultation and just learning more about their circumstances, many times I kind of get a little ringing in my ear, even doing my consultation, where in addition to pulling their credit report, I'll go ahead and request to my processor, hey, could you go ahead and pull this CAVERS report for me? So it definitely has helped to prevent during the application process when the buyer has a binded contract. It really has helped to learn more about that buyer prior to applying. Now, I'm going to talk a little bit about property value. We'll go through some allowable fees that the buyer can pay. But before I do that, were there any questions or any circumstances of what you may have had when it comes to your veteran being eligible for a VA loan, your veteran's credit, your veteran's obligations? Any questions? All right. So after we've kind of analyzed the buyer, as you all know, the property and the valuation of the property is just as important. Now, a few things that are different from an appraiser for a VA loan compared to an FHA loan: the underwriter has to issue what's called a notice of value. So when that appraisal report is completed and it's uploaded into the system, we can't just automatically release that information to you as we would an FHA loan or a conventional loan. The underwriter actually completes what's called a notice of value report. And if you've ever seen it, and again, I thought I had images in here, but my images went away. I may see if I could find one for us. But a notice of value is actually what is issued to the veteran to let them know not only the value of the home, but it also checks if there are any repairs, if it was noted the property was in a flood zone. And so it's that notice of value that informs the veteran of the results of the appraisal report and the conditions that must be met in order to guarantee the loan. And so the notice of value is good for 6 months, which means that typically if an appraisal is done on a property for a veteran, and that loan for whatever reason falls through, then that appraisal is still good on that property for 6 months. Now, one of the things that has happened to me during a transaction, and I'm not sure if it's happened to anyone else on the call, but have you ever heard of the Tidewater Initiative? Has anyone ever heard of that term before? Well, good.
I've heard about it, but I wasn't quite clear. It was just mentioned in something else that I was.
Well, I hope you don't have to hear about it, but a Tidewater Initiative is used when the appraised value of a home falls below its contract purchase price. So when the appraiser invokes a Tidewater, and again, with the 4 or 5 transactions that I've had closed, one of them actually had a Tidewater invoked. And so this essentially means that the appraiser is giving the parties an opportunity to get information that could help him get as close to the contract price as possible. Now, one of the weird things about a Tidewater Initiative, the appraiser is not going to let you know what value he's coming up with. So if you have a $250,000 home, contract price, the appraiser is not going to tell you during this invoke of the Tidewater Initiative, I can see 230. You know, he's not going to tell you a number. You have to provide the supporting documentation to see why I have chosen this 250. And so this is where our realtors really come into play, because you all are going to make sure that you can provide the comps and you're familiar with the area in order to support the contract sales price. Now, when a Tidewater is invoked, you have 2 days to provide that relevant information to the appraiser. Otherwise, he's going to issue his value and report to the underwriter, and the underwriter will issue a notice of value, and that appraisal is what it is. And so again,
that's kind of like the reconsideration then. Like, it's because when you ask an appraiser to reconsider a value, that kind of follows.
You can do a reconsideration on an appraisal once it's been issued, but this is prior to the appraisal report.
Right, but I'm saying
issued.
the process is the same. That's what I'm saying.
Similar
It's a
to,
similar
correct.
process. Yeah.
That is
Okay.
correct, because
That's why I heard it.
That is correct.
Got
You are providing comps. And I believe in the transaction that I had, I think the value was maybe about $15,000 more, or $15,000 less than what the contracted sales price was. And so with that value, the seller and the buyer tried to negotiate. The seller said, well, we're not going to do these repairs now. And the buyer said, well, that's not my fault. So unfortunately, the deal did not go through. So Tidewater for a VA, while it's good for the buyer, it certainly puts a cramp in the staff for the seller. So it's something that I have not, like you said, Kay, I've heard of it. I had an agent in Texas that was going through it maybe earlier this year. And I told her when we talked, I said, now you're telling me this means that it's going to happen to me soon. And just as sure as the sky is blue, it happens. So it's always good to kind of know what that terminology means, because oddly enough, when I mentioned it or spoke with the listing agent in my transaction, they knew nothing of what I talked about when I talked about a Tidewater initiative. So now you guys have been fully informed when you get that term back from your lender that the appraiser has invoked the Tidewater. You are fully in the know now. Any questions about that?
I do have one question. I don't know if it's, well, yeah, it's a question. So, would you suggest, as the loan professional, what would you suggest that the agent who is in the position with you where they are, well, the seller agent, because you were with the buyer, but the seller agent where they are faced with this Tidewater situation, do you invoke their help to bring the value, or is that something the appraiser reaches out to the agent on his own to do? And also, what would you tell is there anything that you would suggest the agent be doing aside from finding comps? Like, is there anything that you say that to help prepare your buyer? You know what I mean? In a situation like that, what do you say to them? Because I can see how $15,000 difference would make a buyer feel like, oh, there's something wrong with the house, because but if the appraiser is giving you a as is value, which means he's not looking for, the seller to make any repairs. You know what I'm saying? Like, if the repairs that they're asking for are cosmetic or things like that, I'm just saying, how do you, as the lender, what would you say to try to help keep it on the deal going? If it was that kind of situation where there were repairs, but they weren't lender required, it was cosmetic, that kind of thing.
And that was actually the scenario that I had, Governor Kay. The repairs that were noted, once the report came back, there weren't any required repairs to be done. This was just negotiated repairs that the buyer and the seller agreed to with the buyer based on the home inspection. Now, to answer your first question, when it comes to who can provide those comps, we actually do lean to the seller's agent, because it's the seller's agent that has, determined that contract price. So we're going to go back and discuss with the seller's agent, what has happened and what he can provide. And I believe in this particular case, the seller's agent provided comps, and they probably, even if I'm correct, noted any renovations or updates that may have been made to the home. While it did not make it a successful appeal to the appraiser, that was information that I recommended that he can include. Now, when it comes to the buyer, I do, of course, educate the buyer on, what has happened in this particular circumstance. And again, while that may not mean the home is up to par, I let them know that it's based on the comparable sales in the area where this type of appraiser appeal may have come into play. And so I do prepare the buyer that, you know, with the change in contract price, the seller may renegotiate the terms of what was initially negotiated, which could be not only repairs to be done, but also seller's concession. You know, that they may want to take their seller's concession away. And unfortunately, with either of those, it may not be favorable for the buyer. But I think it is only right in order to prepare that buyer mentally that the contract terms could change with the change in the sales price if indeed the appraiser is not going to meet the contract price that we initially had. So I do try to prepare that buyer because we don't know exactly how that could turn out for us. Does that help you, Kay?
Yes, that does. Thank you very much.
Mm-hmm. Yeah, but it is the seller that we lean on in order to provide those comps in the area. Any other questions?
Yeah, that's very interesting as it relates to, you know, when we had all those over price properties when, you know, during that time. So I wonder how
what was VA laws that then, right?
I know. What happened then? So I'm just wondering.
Actually now they come in. There are articles out where people people in the industry are starting to squelch that properties are overvalued. So they like 2 years too late, but
Right.
they coming.
That could be why, you know, again, I've been in you know, lending for well over 12, 14 years, and this may have been my second tide water that I've experienced. So will we see more? Will that help control the inflation of the house prices? Again, for that particular buyer, you know, although you can still appeal appraisers, you know, or appraisal reports, but I always thought that was something very interesting when it comes to a VA.
Mm-hmm.
All right. So now we're going to talk a little bit more about allowable fees. And I know this is coming up to the peak of our conversation, but let's talk about the type of fees that a veteran can pay. Now, we've already talked about the funding fee, what that funding fee means, but of course that funding fee is part of the VA policies where they have regulations or limits of fees that the veteran can pay in order to obtain a loan. Lenders must strictly adhere to these limitations. I had a colleague several years ago when they were processing their loan estimate for a veteran, they did not add in the funding fee. And because that loan had been disclosed without the funding fee, even though it's a fee that the buyer can pay, but as a lender, we must strictly even adhere to how we disclose this information to your buyers. Well, we had to eat that fee. And I can remember that because my sales manager, that was, you know, if you talk about 3% of a $300,000 home, that was a fee that we had to eat, and we ate that for a long, long time. But neither here nor there, but we must strictly adhere to the limitations on borrower pay fees when it comes to making VA loans. In addition to the funding fee, the veteran can pay itemized fees and charges, which will include things such as the appraisal fee. Now, the veteran can pay the fee for VA appraisal. They can pay for a second appraisal if we are asking for a reconsideration of value, which you mentioned, Governor Kay. However, the veteran cannot pay for an appraisal requested by the lender or seller for reconsideration of the value. So the veteran can raise their hand and say, I would like that value to be reconsidered, and they can pay for that. Well, if the seller wants to do it, the veteran cannot pay for that appraisal. The veteran cannot pay for appraisals requested by parties other than the veteran or the lender. The veteran can also pay for recording fees, and those are recording fees such as for recording taxes and other charges incident to the recordation. They can pay for credit report fees. The veteran can also pay for prepaid items for portion of taxes assessed.
Like termite inspections, can they pay for those?
They can't pay for those now. You know, at one point, and actually, In my information, it did not include that, but they can, and it may on this next screen, Kay, but yes, they can now pay for termite inspections. Thank you for bringing that up, because I don't think I saw that in here.
And I had an agent argue me down. I was like, yo, because I try to keep up with certain stuff, and I'm like, my seller wants your buyer to pay for their termite. No. I had to send her somewhere. I don't know how I found it, but I did find it. And I'm like, girl, I'm right, girl.
You were right. You were absolutely right, because even with the loans that I've done from this year, I believe the first VA loan that I started with, I had automatically put in my mind that the veteran couldn't pay for their termite inspection as well, okay? But you are absolutely correct. They can pay for that. The flood determination fee, survey, title examination, and title insurance, of course, the VA fee unless they are exempt. They can also pay for the MERS reporting. And MERS is simply just the electronic registration system that we use to always show where that loan was originated. So those are fees that the veteran is allowed to pay. Now, some of the fees and charges that the veteran cannot pay, we just talked about this earlier, right, ladies? The brokerage fee. Fees or commissions charged by a real estate agent or a broker in connection with the VA loan may not be charged or paid by the veteran. The veteran cannot pay any prepayment penalties, nor can they pay any type of HUD or inspection fees that the builder was required to do. So the list is, quite long on what they can do, but they're very specific also on what the veteran cannot be charged for. Now, one of the things that we were talking about coming into this conversation is how this NAR commission settlement has impacted the VA buyers. Well, as we know with the recent settlement and based on what we've just talked about in this presentation, that's one of the fees that as of now, the broker, the buyer, the veteran buyer rather, cannot pay. So we don't know how this is going to change as time goes on. Kay and I talked about, we both read some things where NAR has even written a letter to the VA administration, but as of now, VA guidelines say specifically in full, fees or commissions charged by a real estate agent or broker cannot be paid by the veteran. So I'm definitely looking forward to seeing how these upcoming changes with the NAR commission settlement affects a VA buyer, because, does this put them kind of on the sideline? How as a realtor do you have that conversation with your veteran buyer after July, August, when it comes to that commission? So these are definitely still questions that have not been quite answered for us. And I'm sure you guys are looking forward to it just as I am as well. Any questions? I actually believe that completes my presentation of what I know about a VA loan. I may not know everything, but I have shared with you what I know and things that I've experienced and things that I pulled out the guidelines. A couple of things that I didn't put in there. Remember that your seller can only contribute up to 4% as seller concessions. That's a little bit different from FHA, which is 6%. Conventional is 3%. So when we're talking about kind of how the seller can help the buyer with their costs, remember there is a limit to what that seller can contribute. Let me just check the chat box to see if there are any questions. Yeah. Are there any questions or statements that I did not cover?
I have another one. I'm sorry, I'm hogging everything.
Oh, I love it. I love it.
Make sure we have a robust conversation. So does it matter what criteria? Like, let's just say I had a client who used a VA benefit to purchase a home, and then she was able to use that benefit again to purchase a home. There are, like with FHAs, for example, there are limits, and then there are stipulations that determine whether or not you can use the FHA loan twice or have two FHA loans at a time. You know, there are different criteria that you can meet in order to accomplish that. Is that the case with the VA loans as well? Can the VA, the veteran, use his benefit more than once or simultaneously to own two properties or be, you know, mortgaging two properties at the same time? That's the first question. And the second question is, are VA loans assumable?
So to answer all of your questions, I will wrap it up with a yes, Kay. So a VA buyer can use their benefits, and it's called a subsequent use. So one of our questions in the application is, have you had a VA loan before? If they say yes, that may simply change, for example, their funding fee. We'll also identify if they've used the VA loan through the certificate of eligibility that we discussed earlier. The second part of your question, can they have more than one VA loan? I specifically had a scenario where a buyer had a VA loan and he was interested in purchasing another home, and that VA loan was on his credit report. In that circumstance, and I believe this holds true for VA, kind of similar to FHA, there are certain circumstances that would allow you to have an additional VA loan. And in this case, he was divorced. And in the divorce decree, it stated that the current loan that had the VA loan would go to the spouse. So in that instance, Kay, the buyer was able to obtain a second VA loan, although they did have an active VA loan. And your third question is, VA loans assumable? Yes, they are. Your government loans are going to have that option of being assumable.
Okay.
Thank you very much, madam.
And I think someone in the chat box, Shanita, actually asked the same questions. Can veterans have more than one VA loan at a time? Yes, they can.
Okay, thank you. So, Madam Treissa, are there any restrictions on the type of properties that can be purchased with a VA loan?
No, up to 4 units.
Okay.
Keep in mind, the VA loan is for primary use, though. So the veteran does have to obtain that property with the with occupying the home itself.
Okay. And does VA loans, do they usually have a lower interest rate than the regular, like FHA, let's say conventional?
Not necessarily, depending on the investor that you're going to correspond with. Now, I didn't talk much about programs such as THDA, but they actually offer a 0.5% for their program for Great Choice Loans for their home ownership for heroes. So I believe right now their base rate is 6.625. So with a 0.5% off, that veteran can actually get a 6 1/8 of a point. So depending on the investor that you're going to be choosing, you may see a little bit favorable rate, or again, it could be comparable to what you see for your FHA or your conventional type loans.
Okay, cool.
But remember that even your veteran, they do have the option of buying their rate down.
Okay. Any other questions?
Yeah, if they buy their rate down, do they still have to remain within that 4% bracket for house that they can pay? Because they're actually paying, you know, that's a substantial amount to buy the rate down. If you buying it down a whole point, that could be significant for someone.
Well, now if you're speaking of the
same,
if you're speaking of the seller's concession, no, that does not change the 4% that the seller can contribute. Now there are what we call high price loans, and for any buyer, there is a maximum amount that we can charge a buyer. So depending on the pricing for that particular day, you know, it just depends. There is no set calculation on what the cost of buying your interest rate, whether it's 1/4 of a point or 0.5% down, but the cost can vary.
Okay, yeah, I just wanted to be clear about that, like to separate the two. So but the VA does still consider that a prepayment cost, right? If they buy the rate down, or is that in a separate bucket?
No, it's part of their cost. It's part of their costs and expenses. Am I answering that question for you right?
Yes, you are. Thank you.
Okay. Yeah. So that is something that the VA buyer themselves can pay. I actually, in one of the many loans I closed earlier this month, or earlier this year rather, the seller was contributing $9,000 towards the buyer's closing costs and fees, but they were very specific that it is the buyer that's responsible for paying their own discount points. And in this scenario, the buyer did choose to buy their rate down, and so they did have to bring those funds to close.
And specifically, VA is only a fixed rate. You can't do an adjustable rate on the VA, correct?
I believe you can do an adjustable rate on the VA loan. You can do a temporary buy down. The terms of that are all across the board.
Okay.
The buy down starts out with a temporary rate, doesn't it? I mean, kind of, sort of, it's fixed for a specific amount of time.
Yeah.
Correct. So there's two types of buy down rates. You have a temporary buy down and you have a permanent buy down.
Right, like 2-1.
Correct. So depending on the investor or the correspondent that we're using, those options may be available.
Right.
Good questions. Thank you all so much for just enlightening even me, because some of these things, like I said, I couldn't think of everything. I knew I was missing a few things. So I appreciate you all for just bringing it on out for me.
We appreciate you. Can you go back over again? I think somebody just came in. Just go back over again. This NAREB thing is still in my mind. As far as cost, so how it's going to be really kind of challenging for the veterans to get a buyer's agent when you look at the structure.
It's going to be a little challenging.
Yeah,
we can.
Right. So with the structure, I mean, how would you think that 3% or 2.5, whatever, could come in so the golden rule, I guess, or the golden thing for a veteran is I'm getting in for zero down, 100%, and then get the seller to pay the closing cost. That's it. So how, I know we talked about that earlier, but how in the world could you fit that in? Because that's going to have to come, and it can't come from the buyer because we already talked about it, right?
It cannot, because while it's 100% financing, many veteran buyers thinks that covers their closing costs. I've had veteran buyers to come in with their closing costs, so that does not completely alleviate their investment into the transaction. But when it comes to real estate fees and commissions, even if the veteran buyer wanted to, they couldn't.
Right.
And so the only thing they have is the 4% commission. And so I think one of the things we kind of touched on earlier is that the way the contracts are going to be written, let's say that in the agreement, the seller only agrees to use their 3% concessions to cover the buyer's real estate commission fees. Well, that means that the buyer is still responsible for their own closing fees. Now, I kind of think this is possibly where down payment assistance programs such as THDA or Mississippi Home Corp could really make a big impact, so that the veteran buyer is getting the benefits of having both seller concession and using down payment assistance. So that's kind of in my mind the way that I kind of worked out a workaround. Correct. But I think it would have to be very specific in the contract that, just like my previous transaction where the seller said, we're going to pay $9,000, but purchaser has to pay this. Well, they specifically said what they weren't going to pay those fees to. So in our case, we're going to have to make sure the seller is specifically saying what they are going to pay those fees to.
Right. Okay.
What do you think, Treissa, if they because really and truly, I mean, let's be honest, the compensation agreement is typically between the two agents.
Mm-hmm.
So do you think it would raise alarms if someone says something because sometimes the seller is paying up to a certain percent, like sometimes the seller you may get a contract where the buyer is asking for up to 4% or whatever for closing costs and prepays, and the seller agrees to pay the 4%. I mean, could they not break that down in like an addendum or something that says so many dollars are going towards the buyer's commission from these concessions like that?
I think so, Governor Kay, but again, it all boils down to the contract. And as you know, as a lender, I'm only looking at how the contract has been executed. So I think all of our questions and how this is going to be structured is really going to be bounded by that contract itself. Because we're going to go by however that contract states. I could have put that $9,000 on my previous buyer to every penny that the buyer had to pay. However, when it came down to the contract, you know, even down to the attorney, it was worded that the seller is not going to be paying any points that the buyer has chose to buy their rate down.
Right.
So it's really going to be how that contract is written.
So then what I'm getting really is, and what I guess we all should be, what we should be saying, just for the purposes of safety of, you know, agents protecting them. If they have any questions about any positions where there are any contracts where they have a mixture of things going on and costs like that, then they maybe should reach out to their broker or to the attorney that they're working with to close the transaction, to be sure that they're wording the contract in a way that satisfies VA, but that also guarantees their commission at the end.
I absolutely agree with that, because we're only going to go by how it's written in the contract.
Madam McGowan, hello there. Madam Governor, you have your hand up.
Yes. Hello, everyone. Good evening. I wanted to just chime in a little bit on the VA. As you all know, I had to go to Nashville last week because we are updating the contracts. So it has been a challenge because we have like 3 different attorneys across the state. And so one of the things we have to be very cautious of is making sure that we abide by what's outlined from the Department of Justice, the DOJ, as it relates to who pay who, how many apples we get paid. I'm trying to stay away from the numbers, how many peaches we gonna get paid on this side. So I think a lot of it is we have to go back, because one of the things that we are waiting on as a committee, you know, we're waiting to hear from VA what we can and can't do, you know, what they're going to allow and what they're not going to allow. And then we as practitioners are going to have to try to figure out how we're going to service clients that want to use their VA entitlement. And right now, the way it looks, you know, we're not going to get any apples and oranges unless they buy prior to the deadline of the date that this is supposed to go in effect. I think it's August 19th. So I just want to suggest to everyone is to make sure that you are following up with the DOJ, that you are following up with the emails that we get from NAR every couple of days that are giving us updates. When I say there are so many attorneys working on it, and your committee for the state, we are working on documents so that we can have all of these documents in place so that we could be ready. So I just wanted to say that, and I just hope that VA comes up with something, because when individuals service our country, this is what they were promised. When you service the country, you're going to be able to use this entitlement. You're going to be able to use this loan, and it's 100% down. But with everything changing and the seller not able to pay, that's going to create a problem as to how buyers agents are paid. So I just wanted to throw that out there and tell everybody it's just a lot of reading out there, but we have to kind of read and kind of stay on top of it. And your Tennessee Realtors Committee is working hard to make sure that we get these documents out to everybody in a timely fashion so that we all can be ready for, I think it's August 19th.
Is it August 19th when they're going to take the
17th or 19th? Yeah, they're supposed to be taking out.
I think.
The 17th. They'll be taking out the, and some associations have done it already, where they've already taken the commission out of the MLS.
Right. Okay.
Yeah, and the document of the listing agent, how much they're agreeing to pay the buyer's agent, that form is going to be taken away because they, everyone is supposed to negotiate their fees with their parties that they're working with.
So there's not going to be a co-op agreement at all, correct? So there's not going to be a co-op agreement at all, correctly?
No, because the agreement is the seller's agent has to negotiate their fees with the seller.
Right.
Now, it depends on how each thing is different. That means we're going to work really hard because we got to pick up phones and call and email and find out what's what, so we know how to structure a deal.
It's going to be interesting.
It's going to be very interesting because sometimes seller will pay a bonus to the buyer's agents for bringing an offer. We haven't worked through that to know, can the seller pay a bonus to the buyer's agent? So it's still a lot going on, and everybody's working 24/7 so we can meet the timeline. So I'm just saying to everybody, we're working, but we all as practitioners are responsible ourselves to take and read this information. So I just wanted to suggest to everybody to start reading because it's a lot, and days are passing by quickly.
Yeah.
Mm-hmm. And as lenders, we are communicated when changes are made through Fannie Mae, Freddie Mac, FHA, VA. So I know when that information becomes available, it should be widespread to where lenders would be able to inform you all, and I'm sure you'll know it well. But as of now, VA has been quiet as a mouse. Mm-hmm. They have been quiet as a mouse. I read through the guidelines when I was completing this presentation, and there's been no changes for years.
So that's what I saw, Madam Treasurer. No changes for years. I was like, what in the world?
It has been, other than that termite. That's been that's probably the biggest
the only
change.
They changed it.
So it has been interesting. Shanita had a question, and I don't think I touched on your particular question, but she asked, can a veteran pass their benefits to their children? No, they cannot. As of now, only a veteran spouse or surviving spouse may be eligible to use their VA benefits. So that dependent would have to have their own eligibility for using the VA loan. Shanita also asked when we were talking about non-commission, can agents offer to work for veterans pro bono? I can't really answer that question. I'm not sure how that works. If anyone can chime in, please do so. And she's right, other professionals do it, and they've served our country, and they deserve not to be almost blackballed out of this market.
I think we all work pro bono sometimes, and we have friends and family, people that's going to call us to give us information.
So you're right
I'm
about
sure
that.
Our VA friends, they'll continue to call us. We're not going to just say, I'm not going to tell you what you need. I'm not going to look over your contract. I'm not going again, I think moving forward, we just have to be prayerful. And again, we have to make sure that they know how valuable we are, the resources as a buyer's agent, because otherwise we're going to see a huge falling away of buyer's agents, because they can't make money if you have the sellers, the listing agent always having the listing. That's why, again, we got to go toward developing, flipping houses, increasing inventory, doing something different. We're going to have to change lanes. We're really gonna have to change lanes. Yeah.
Well, hopefully by August or before then, we would have some information to know how we can continue to help our VA.
Absolutely. Any other questions? If not, thank you so very much, Madam Treissa, for all that valuable information. Some we didn't know, some we needed to just be brushed up on. Thank you so much. Thank you, Madam Kay, Madam Wanda, Madam Shanita. Hey, Madam Nidra. I don't know if you're there, but hello, and everybody else that joined.
Hello.
Hey, did you want to say anything before we close out?
No, good information.
Okay, great. So I hope everybody can come to our next event, Let the Church Say Amen, June the 1st. 2024, the first day of National Home Ownership Month. So hopefully and prayerfully we'll all see you all there, and we have some robust conversation. We'll probably even talk about this a little bit of everything. We'll be sending more information about the panelists on the flyer probably tomorrow. But thanks again, everyone. I see neither one of our chaplains is on, so let's close in prayer. God, thank you for this moment. Thank you for this time. Thank you for everybody that was represented here. We thank you for the information. We thank you for the opportunity to learn more. We thank you to God for the encouragement to continue to make sure that we're staying abreast of what's going on, so we'll better be able to serve our communities. Continue to order our steps, continue to bless our families, keep us safe until we meet again. In Jesus' name we pray. Amen.
Amen. Everybody be safe.
Good
Thank
night,
you, guys.
Have a good evening. Bye-bye.
Bye now.